Listen to me, and listen to me very carefully. If you are retired right now, or if you are sitting at your kitchen table counting down the months until you turn in those keys and walk into retirement, I know exactly what you did today. You logged into your account, you looked at that balance, and your heart dropped right into your stomach. You saw thousands of dollars vanish in a market dip, and your immediate instinct was fear. You thought to yourself, is my retirement wiped out? Should I sell everything right now before I lose another single penny? Stop right there. Take a deep breath and stand up straight. Fear is the absolute single greatest destroyer of wealth, and I am not going to let fear dictate your financial future. When you are 25 or 30 years old and the market drops, it's a sale. You don't care because you've got decades ahead of you. But when you are 60, 65, or 70, a dropping stock market feels like a threat to your survival. I understand that fear. It is a completely real emotion. You worked 40 years for that money. You saved, you sacrificed, and the idea of watching your cushion shrink when you no longer have a paycheck coming in is terrifying. But here is the truth you need to hear: market volatility is not a surprise, it is a guarantee. The market goes up, and the market goes down. That is how the system is designed. But what you do during the down days determines whether you stay secure or ruin your retirement. So let's answer the ultimate question: how do you stay calm and protect yourself when your balance dips? First, you must understand that paper losses are not real losses until you press that sell button. When the stock market drops 10%, 15%, or 20%, you haven't lost actual money unless you panic and sell your shares. When you sell in a panic, you lock in those losses permanently. You turn a temporary downturn into a permanent catastrophe. Second, if you are doing retirement right, you should never be relying on the stock market to pay your immediate living expenses. Money that you need in the next 3 to 5 years does not belong in stocks. Period. If you need that cash to pay your mortgage, your groceries, your Medicare premiums, or your utility bills next month or next year, it should already be safe and sound in cash equivalents, a high-yield savings account, short-term treasuries, or certificates of deposit. Why? Because when you have 2 to 3 years of essential living expenses parked safely in guaranteed cash, alongside your Social Security or pension, you can look at a stock market drop and say, so what? You don't care what the market does today or next week because you don't need to sell a single share of stock to pay your bills. You have bought yourself time. You have given your portfolio the exact breathing room it needs to bounce back, just like history has shown us it does time and time again. Third, look at how your money is actually invested. Are you holding individual stocks that keep you awake at night worrying if the company will go under? Why are you doing that to your health and your peace of mind? At this stage in your life, your foundation should be in low-cost, broad market index funds or ETFs. When you own an index fund, you own hundreds of the top companies in the world. Individual companies can go bankrupt, but broad markets recover. Diversification is your armor against panic. No single stock should ever make up more than 5% of your portfolio. And if you are still making contributions because you haven't retired yet, market dips are actually working in your favor. When prices drop, your regular dollar-cost averaging buys more shares at a discount. You are buying quality assets on sale. My goal for you has never been just to make you rich. My goal is for you to have peace of mind. Money is a tool to give you security, freedom, and sleep at night. If looking at your account balance every morning makes your blood pressure spike, close the computer. Turn off the financial news channels that profit off your panic. Check your cash reserves, make sure your basic expenses are covered, keep your portfolio properly diversified, and let the market do what it always does: cycle through the storm and come back stronger. You are going to be okay, but only if you stay disciplined, stand in your truth, and refuse to let fear make your financial decisions.